there, my beautiful people. It's your favorite auntie, Queen Marie.
Hey, beautiful people.
Hey there, beautiful people. Hey there, beautiful people.
Entity formation and tax implications. Welcome, everyone, to today's presentation on business entity formation and tax implications. The world of business is vast and varied, and one of the foundational decisions any entrepreneur or business owner must make is the type of business entity to form. This decision not only shapes the legal framework of the business, but also has profound tax implications. Understanding the importance and impact of different entities underscores the need for clarity in this area. By the end of this video, you'll have a clearer understanding of the different business entities available and the tax consequences associated with each. To get started, let's overview business entity formation and the significance of forming the right business structure. Diving right in, let's talk about the concept of business entity formation. At its core, business entity formation is the process of legally establishing a business, defining its structure, and setting its operational framework. Whether you're a solo entrepreneur or part of a group, the type of business entity you choose will dictate many aspects of your business operations, from how you can raise capital to how you're taxed. But why is this so important? The significance of choosing the right business structure cannot be overstated. It affects your personal liability, how much you pay in taxes, the ability to raise money, the paperwork you need to file, and even the potential future of your business. Making an informed decision at the outset can save a business owner from future complications, legal troubles, and unfavorable tax situations. In the upcoming slides, we'll delve deeper into the specifics of different business entities, such as partnerships, S-Corp, C-Corp, and nonprofits, and explore the tax implications for each. This knowledge will empower you to make informed decisions for your current or future business ventures. Why business entity formation matters. As we delve deeper into the world of business entities, it's essential to understand the fundamental reasons why business entity formation is so crucial. Firstly, legal protection. One of the primary reasons businesses formalize their structure is to protect the personal assets of the owners. For instance, in a sole proprietorship, there's no distinction between the owner and the business. This means that the owner's personal assets, like their home or savings, could be at risk if the business incurs debt or faces a lawsuit. However, with entities like corporations or limited liability companies, there's a legal distinction between the business and its owners, offering a shield to personal assets. Secondly, credibility with stakeholders. A formally established business entity often carries more weight and trustworthiness in the eyes of potential investors, partners, customers, and even employees. It signals commitment, seriousness, and a level of professionalism. This credibility can be instrumental in building strong business relationships and fostering growth. Benefits of proper formation. Beyond the foundational reasons, there are several tangible benefits to properly forming your business entity. Financing opportunities become more accessible with a formal business structure. Investors and lenders often prefer, or even require, businesses to have a specific legal structure before they consider funding. For instance, venture capitalists typically invest in corporations, not sole proprietorships or partnerships. A well-defined entity can also help in securing better terms on loans or credit lines. Succession planning is another critical aspect. Every business owner should consider what happens to their business in the event of retirement, incapacitation, or even death. With a proper business structure, there are clear guidelines and procedures in place for business continuity. It ensures that the business can either be passed on seamlessly or dissolved in an orderly manner, protecting both business assets and stakeholders. Partnerships, an introduction. Now, let's dive into one of the most common business entities, partnerships. A partnership is defined as a business arrangement where two or more individuals collaborate to run a business. Each partner contributes to the business, whether it's in the form of capital, labor, skills, or assets, and in return, each partner shares the profits and losses of the business. There are three primary types of partnerships. General partnership, GP. In a GP, all partners share equal rights and responsibilities in managing the business. They also share liability for the business's debts and obligations. Limited partnership, LP. LPs have at least one general partner with unlimited liability and one or more limited partners with liability limited to their investment in the business. Limited partners typically don't participate in day-to-day management. Limited liability partnership, LLP. An LLP is similar to a general partnership but offers limited liability protection to its partners. It's a popular choice among professionals like lawyers or accountants. Each type has its nuances, benefits, and challenges, especially when it comes to tax implications, which we'll delve into in the upcoming slides. Partnerships, tax implications. When it comes to partnerships, one of the most significant tax features is the concept of pass-through taxation. Unlike corporations, partnerships aren't taxed at the business level. Instead, the profits and losses of the business pass through to the individual partners, who then report this income on their personal tax returns. This structure avoids the double taxation issue that some other business entities face. However, with this structure comes individual partner responsibilities. Each partner is responsible for paying taxes on their share of the partnership income. This includes federal and state income taxes, as well as self-employment taxes. Partners must also pay estimated taxes quarterly, as there's no employer withholding taxes from their income. It's crucial for partners to be aware of their tax obligations and to plan accordingly to avoid potential penalties. Partnerships, more on taxes. Diving deeper into the tax implications for partners, there's the matter of self-employment taxes. Partners in a partnership are considered self-employed for tax purposes. This means they're responsible for both the employer and employee portions of Social Security and Medicare taxes, which can be higher than what salaried employees pay. However, partners can deduct the employer equivalent portion when calculating their adjusted gross income, which can offer some tax relief. Furthermore, partners can take advantage of various deductions and credits available to businesses. This includes deductions for business expenses like rent, utilities, and supplies. Additionally, there are specific tax credits available for certain activities, such as hiring employees from particular groups or investing in research and development. Being aware of these deductions and credits can significantly reduce a partner's tax liability. S corporations. Introduction. Transitioning from partnerships, let's explore S corporations or S-Corp. An S corporation is a type of corporation that meets specific Internal Revenue Service criteria, allowing it to avoid paying federal income taxes. Instead, similar to a partnership, the company's income, deductions, and credits flow through to shareholders who report this on their individual tax returns. Several key characteristics define S-Corp. Limited liability. Shareholders have limited liability protection, meaning their personal assets are protected from business debts and claims. Shareholder restrictions. S-Corp can have no more than 100 shareholders, and they must be U.S. citizens or residents. One class of stock. Unlike C corporations, S-Corp can only have one class of stock. Pass-through taxation. As mentioned, S-Corp avoids double taxation by passing corporate income, losses, deductions, and credits through to shareholders. The S-Corp structure offers a blend of the benefits of a corporation and a partnership, making it an attractive option for many business owners. S-Corps, tax implications. One of the primary attractions of S corporations is their unique tax treatment. The pass-through taxation benefits mean that the corporation itself does not pay federal income taxes. Instead, the income, losses, deductions, and credits of the corporation pass through to the individual shareholders, who then report this on their personal tax returns. This structure ensures that the business income is only taxed once at the shareholder level. This leads to the avoidance of double taxation, a significant advantage over traditional C corporations. In many corporations, profits are taxed at the corporate level and then again at the individual level when distributed as dividends. With S Corp, this double hit is avoided, leading to potential tax savings for shareholders. S Corps, salary and dividends. When it comes to compensation in an S corporation, there are two primary methods: salary and dividends. Salary distributions refer to the wages or salaries paid to the shareholder employees of the corporation. These salaries are subject to federal income tax and FICA, Social Security and Medicare taxes. S Corp are required to pay reasonable salaries to shareholder employees before making any dividend distributions. Dividend distributions are the profits distributed to shareholders after paying out salaries and other business expenses. These distributions are not subject to self-employment taxes, making them a tax-efficient way to extract profits from the corporation. However, it's crucial to strike a balance between salary and dividend distributions to avoid IRS scrutiny. C corporations. Introduction. Moving on to C corporations or C Corp. A C corporation is the standard corporation under IRS rules. It's a separate legal entity from its owners and provides them with limited liability protection. The key characteristics of C Corp include separate tax entity. C Corp pay corporate income tax on their profits. No shareholder restrictions. Unlike S Corp, C Corp can have an unlimited number of shareholders, and there's no citizenship or residency requirement. Multiple classes of stock. C Corps can issue multiple classes of stock, allowing for different types of shareholders with varying rights. C Corp tax implications. The tax structure of C corporations is where they differ significantly from S Corp. C Corp are subject to corporate income tax. This means the corporation pays taxes on its profits at the corporate level. However, this leads to the potential for double taxation. When a C Corp distributes its after-tax profits to shareholders in the form of dividends, these dividends are taxed again at the individual shareholder's tax rate. This double layer of taxation, first at the corporate level and then at the individual level, is a significant consideration for business owners when deciding between an S Corp and a C Corp structure. C Corp dividends. Dividend distributions are a primary method C corporations use to distribute profits to shareholders. After the corporation pays its corporate income tax on profits, the remaining after-tax profits can be distributed to shareholders as dividends. However, these dividends come with their own set of tax rates and considerations. Dividends are typically taxed at the individual shareholder's dividend tax rate, which can vary based on their overall income and tax bracket. It's essential to note that this is where the potential for double taxation comes into play. The corporation pays tax on its profits, and then shareholders pay tax again on the dividends they receive. This dual layer of taxation is a significant factor for business owners and investors to consider when evaluating the benefits and drawbacks of the C corporation structure. Nonprofits. Introduction. Shifting our focus from for-profit entities, let's delve into the realm of nonprofits. By definition, nonprofit organizations operate primarily to provide benefits to the public rather than to earn profits for its owners or shareholders. They play a vital role in society, addressing issues and needs that for-profit companies might overlook. There are various types of nonprofit organizations, each with its specific purpose and tax implications. The most common is the 501(c)(3), which includes charitable, religious, educational, and scientific organizations. Donations to these organizations are typically tax-deductible for the donor. Another type is the 501(c)(4), which encompasses civic leagues and social welfare organizations. While they can engage in some political activities, it's not their primary purpose, and donations to them are not tax-deductible. Nonprofits. Tax implications. One of the primary advantages of nonprofit organizations is their tax-exempt status. This means that they are exempt from paying federal income tax on the income related to their charitable mission. This exemption allows more of their resources to be directed toward their mission and services. However, this status comes with its own set of benefits and limitations. While they are exempt from federal income tax, nonprofits might still be liable for other taxes, such as employment taxes or unrelated business income tax, UBIT, on income not related to their primary mission. Additionally, to maintain their tax-exempt status, nonprofits must adhere to specific guidelines. For instance, they must operate primarily to fulfill their mission, avoid political campaign activity, and ensure that earnings do not benefit any private individual or shareholder. Nonprofits, UBIT, and donations. While nonprofits benefit from tax-exempt status, they aren't exempt from all forms of taxation. One such tax is the unrelated business income tax, UBIT. UBIT is levied on income generated from activities unrelated to the nonprofit's primary mission. For example, if a charitable organization runs a business on the side that's not directly related to its charitable purpose, the profits from that business could be subject to UBIT. On the brighter side, nonprofits have the advantage of receiving donations and grants. These funds are often tax-free for the organization and can provide a significant portion of their operating budget. Furthermore, donors to 501(c)(3) organizations can typically deduct their donations on their personal tax returns, making it an incentive for individuals and corporations to support charitable causes. Comparison. Introduction. As we delve into comparisons between different business entities, it's crucial to grasp the importance of understanding these differences. Each entity type offers unique advantages and challenges, and the right choice can significantly impact a business's operational efficiency, tax liability, and growth potential. There are several factors to consider when comparing business entities. These include the business's size, the number of owners, the desired level of control, potential vulnerability to lawsuits, tax implications, and future needs for raising capital. By understanding these factors and how they relate to each entity type, business owners can make informed decisions that align with their goals and vision. Comparison: partnerships versus S-Corp. When comparing partnerships and S-corporations, there are distinct differences to note. Tax implications. Partnerships. Profits and losses pass through directly to the partners, who report them on their personal tax returns. Partners are also subject to self-employment taxes. S-Corp. Like partnerships, S-Corp have pass-through taxation, but there's a distinction between salary and dividend income. Shareholder employees must receive a reasonable salary, which is subject to employment taxes, but any additional profits distributed as dividends are not subject to self-employment taxes. Business considerations. Partnerships. All partners typically have a say in the management and decision-making processes unless specified otherwise in a partnership agreement. Liability is also a concern, especially in general partnerships where partners have joint and several liabilities. S-Corp. Shareholders enjoy limited liability protection, and the corporation can have up to 100 shareholders. There's more flexibility in profit distribution, and the entity can continue indefinitely, unlike some partnerships that dissolve upon a partner's death or withdrawal. Comparison: S-Corp versus C-Corp. When comparing S-corporations and C-corporations, several key distinctions emerge. Tax differences. S-Corp operates with pass-through taxation, meaning the corporation itself doesn't pay federal income taxes. Instead, the income, losses, deductions, and credits flow through to shareholders, who report this on their personal tax returns. C-Corp, subject to double taxation. The corporation pays corporate income tax on its profits. When these profits are distributed to shareholders as dividends, they're taxed again at the individual's dividend tax rate. Business structure considerations. S-Corp. Restrictions include a maximum of 100 shareholders, all of whom must be U.S. citizens or residents. They can only issue one class of stock. C-Corp. No restrictions on the number or type of shareholders. They can issue multiple classes of stock, providing flexibility in ownership structure and profit distribution. Comparison: C-Corp versus nonprofits. Comparing C corporations and nonprofits reveals a contrast in purpose, structure, and taxation. Tax implications. C Corp. As mentioned, they face double taxation, first at the corporate level and then at the individual level on dividends. Nonprofits generally enjoy tax-exempt status for income related to their charitable mission. However, they may be subject to UBIT for income from unrelated activities. Purpose and mission considerations. C Corp. Operate to generate profits for shareholders. While they can and often do engage in philanthropic activities, their primary goal is profitability. Nonprofits operate primarily to serve a public good or fulfill a specific mission. Any profits made are reinvested into the organization's mission rather than distributed to individuals. Conclusion. Recap. As we conclude our exploration into business entities and their tax implications, a few key takeaways emerge. The importance of business entity formation cannot be stressed enough. The structure chosen can profoundly impact the legal protection of owners, the ability to raise capital, and the potential for business growth and continuity. Furthermore, the chosen entity has a significant impact on taxes and operations. From pass-through taxation benefits in S-Corp and partnerships to the double taxation faced by C-Corp, understanding these implications is crucial for financial planning and compliance. Whether you're an entrepreneur starting a new venture or an existing business owner considering a change in structure, being informed about these differences is essential for making the best decisions for your business's future. Conclusion: professional advice. While this presentation provides a comprehensive overview of business entities and their tax implications, it's essential to emphasize the importance of seeking professional advice tailored to individual business needs. Consultation with accountants is crucial. An experienced accountant can provide insights into the financial and tax implications of each business structure, helping business owners understand potential tax liabilities, available due.